Usually when we talk about winning, there's this underlying assumption that winning actually means being successful.
Right. Yeah, it seems completely obvious.
Like going to a carnival and playing that ring toss game. You hit your target 9 times out of 10, you get all these little plastic keychains, and you feel like an absolute champion.
Absolutely. At least until you check your wallet.
Exactly. You realize you just spent $50 to win like $3 worth of plastic. You won the game, but you definitely lost the night.
It's a classic trap, honestly. The mechanics of rooting completely mask the reality of the math.
Yeah.
You get that dopamine hit from the frequent successes, and it just blinds you to the slow bleed of your capital.
And that precise illusion is exactly what we are decoding today. So welcome to another custom-tailored deep dive designed specifically for you.
I am really glad to be here to get into this one.
Today, we're opening up an incredibly revealing daily performance log from June 18th. We are looking at the algorithmic diary of 4 different MT5 auto trading bots.
And just for some quick context, MT5 is essentially the standard software terminal these automated systems use to plug directly into the global financial markets.
Right, exactly. So the mission for this deep dive is to solve a really fascinating statistical mystery.
It really is a paradox when you look at the raw data from that day. I mean, it's wild.
Right. Like, how does a portfolio of advanced AI and automated trading bots achieve a staggering 75% win rate, winning 27 out of 36 trades in a single day, but still end that exact same day in the red, losing 464 yen?
It sounds impossible on paper.
It does. But this isn't just a dry finance story. This is a look directly under the hood of AI decision-making. Okay, let's unpack this.
To understand what actually happened on June 18th, we really have to look past that flashy 75% win rate and analyze the actual architecture of the risk.
Okay.
Because the surface numbers are a gross profit of positive 2,014 yen against a gross loss of negative 2,478 yen. Yeah. When you divide the average win by the average loss, you get what is called the payoff ratio. For this entire portfolio, the payoff ratio sat at a dismal 0.27.
Okay, so just to ground that, in reality, a 0.27 payoff ratio means that for every unit of risk they take on a bad trade, they are only capturing about a quarter of that back on their successful trades.
Precisely.
It implies they're taking massive losses and grabbing just these tiny, incremental wins.
That is exactly the core theme of today's deep dive. We're exploring exactly how and why high conviction on an entry completely failed to protect these systems on the downside.
Right, they had no problem getting in.
None at all. These bots easily identified opportunities to enter the market. The fundamental flaw was entirely in the exit strategy. They were built with incredible confidence to start a trade, but possessed almost no logic on when to stop believing in their own initial assessments.
Let's follow that logic into the specific bots, because rather than just listing off stats, looking at how each system failed tells a really compelling story about algorithmic design.
It really does.
Let's start with a bot called GateGrid AI. It was trading the GBPUSD pair, so betting on the British pound against the US dollar.
Right.
On paper, it looks highly effective. You had an 81% win rate, 17 wins, 4 losses. But the final tally for the day was negative 155 yen. I'm looking at the log, and I see these 2 massive initial losses. How does an 81% win rate create a negative return?
It comes down to the underlying mechanism of a grid strategy. A grid bot operates by layering positions. So if it buys and the price drops, instead of cutting its losses, it just buys more at a cheaper price.
Oh, assuming the market will eventually bounce back.
Exactly. Programmers build these because in a sideways market, it practically guarantees a high win rate. You are constantly closing out small, overlapping profits.
Right.
But it requires taking on immense floating risk.
So it's essentially averaging down on a bad idea until the market forgives it. But on June 18th, the market didn't forgive it.
No, it did not. GateGrid AI hit a massive directional wall right out of the gate. The log details show its first 2 closed trades were substantial losses, negative 379 yen and negative 443 yen.
Ouch. That is rough.
Yeah, the accumulated risk grew so large, so fast, that it actually triggered a hard-coded safety mechanism in the bot system.
I have that exact line from the log here. It reads, cap basket max loss exit, P&L equals negative 822, which is less than or equal to negative 800.
Yeah.
So this wasn't an intelligent exit at all. This was just a circuit breaker.
Exactly. It is the system violently pulling the plug. The developers hard-coded an absolute ceiling for acceptable losses, a threshold of negative 800 yen.
Right.
Once the grid strategy pushed the account past that, the bot just dumped everything to stop the hemorrhage. Because of that massive early hole, the bot spent the entire rest of the day frantically clawing back tiny incremental profits.
Which totally explains the 81% win rate. It just kept taking these micro wins to survive.
Yeah, right. Its payoff ratio was only 0.20. The grid logic might look hyperactive and controlled on a chart, taking 17 successful bites out of the market.
Yeah.
But it's structurally flawed. It's the equivalent of picking up pennies in front of a steamroller. Eventually, the steamroller catches you.
So GateGrid failed because its fundamental strategy required a hard-coded panic button to survive. But what happens if you remove that panic button and let a simpler algorithm just run its course?
That is a great question.
That leads us directly to the BoundSniper log. It was trading the USDJPY pair, so the US dollar, against the Japanese yen. It achieved an 85.7% win rate. 6 wins, 1 loss.
Okay.
And its total profit for the entire day was a whopping positive 20 yen. It's like an insurance company that happily collects $10 a month in premiums for years, feeling incredibly successful, but completely lacking a financial plan for when a $100,000 hurricane hits.
Yeah, that is the perfect analogy for asymmetrical risk. The business model isn't built to survive the inevitable anomaly. BoundSniper made 446 yen across its 6 wins and then gave back 426 yen in one single catastrophic loss.
Wow.
Its payoff ratio was an atrocious 0.17.
But BoundSniper isn't using the same LLM or large language model planning as the other bots. Why is it making the exact same mistake?
Because it points to a universal design issue in automated trading and, honestly, a flaw in developer psychology.
Developer psychology? What do you mean?
Well, why do programmers build bots with terrible payoff ratios? Because they're often designing these systems to appeal to human psychology.
Yeah.
Humans inherently prefer frequent, small wins. We
Yeah.
hate losing.
True.
A bot with an 85% win rate looks incredible on a marketing brochure. So to achieve that, developers code the system to take profits extremely fast, often prematurely, while giving losing trades massive amounts of room to breathe.
Hoping they eventually turn around.
Exactly. The win rate is almost a vanity metric baked into the code at the expense of long-term survival. The system fundamentally does not know how to stop the bleeding on a bad trade.
So one bad exit consumes an entire clean run of small, successful closes.
Right, until it hits a disastrous technical stop.
If dumb algorithmic exits are the problem, does adding AI confidence scores fix it? We pivot to the ML score bot to see what happens when AI is actually too confident in a bad idea.
This is where the mechanics of machine learning intersect with market reality in a really dangerous way.
The stats on this one on the GBPUSD-Closed pair are wild. This bot had the lowest win rate of the group, 33.3%, 1 win, 2 losses.
Yeah.
But ironically, it had the best payoff ratio of the group at 1.06, yet it still lost negative 237 yen overall.
It is a fascinating contradiction. The structure of the trades wasn't terrible, really. It took 2 losses around negative 250 yen each and had 1 win at positive 265 yen. So that symmetry gives it that healthy 1.06 payoff ratio. The problem wasn't the mathematical structure of the risk. The problem was that the timing was completely off.
I want to zero in on exactly the log output here. It says candidate equals sell, decision equals enter, signal equals sell, score equals 95.09, trade equals done.
Yes.
If an AI spits out a 95.09 confidence score, which feels incredibly strong, how does that exact trade end up closing at a negative 252 yen loss?
Well, if we connect this to the bigger picture, it reveals a fundamental misunderstanding of what a confidence score actually is. That 95.09 score is just a snapshot in time.
Oh, I see.
It means that, based on the AI's training data, this specific alignment of technical factors resulted in a successful sell-off 95% of the time in the past.
But the past isn't the present.
Exactly. A high entry score doesn't guarantee market follow-through. The AI was using the score as the main gate for entry, but lacked a secondary layer to judge if a high score setup was simply arriving too late to the party.
Oh, wow. It's like looking at a weather radar from an hour ago that says it's 95% likely to be sunny, but refusing to actually look out the window to see the massive storm clouds rolling in right now.
That captures it perfectly. The AI had an incredibly sophisticated way of entering the room, but no situational awareness once that got inside. It blindly trusted the entry score.
which creates the perfect transition to the one bot in this entire portfolio that actually seemed to look out the window.
Yeah, LLM bridge trader.
Right. We are moving from bots blindly holding on to bad trades to the one bot that actually showed a glimmer of true intelligence and adaptability in its exit strategy.
This is definitely the silver lining of the June 18th logs. It provides a blueprint for what true artificial intelligence in trading should actually look like.
To be clear up front, this bot still lost money on the day. It traded USD and finished at negative 92 yen, with a 60% win rate, 3 wins and 2 losses.
Yeah, but it lost the daily battle while showing exactly how a system can evolve to win the long-term war. Because the source material excitedly points out that this bot provided the absolute most useful AI log of the entire day. I'm looking at the specific trade breakdown here. The model opened a BUY position based on a mean reversion setup,
Right.
which is basically an RSI oversold bounce in a weak-ranging market.
Yeah, and just to briefly translate the mechanics there, RSI, or the Relative Strength Index, is basically the bot's way of measuring how exhausted a market trend is.
Okay.
It saw the market dip too far, too fast, without much volume behind it, and logically bet that it would bounce back up. It is a completely standard entry.
Yeah.
But what happens 15 minutes later is what makes this bot different.
15 minutes after opening the trade, the bot executed the command position action close. And it provided its specific reasoning in the log weak ADX and bearish structure favor closing.
Yes.
That active decision resulted in a positive 90 yen win.
What's fascinating here is the secondary layer of analysis. It didn't just look at the RSI, it also analyzed the ADX, which is an indicator that measures the actual strength and momentum of a trend.
Right. The bot opened the trade expecting a bounce, but as the live data rolled in, it saw the ADX was weak, meaning there was no real momentum supporting the bounce, and the broader market structure was turning bearish.
So it realized the environment had fundamentally changed, and it actively chose to close the trade.
Exactly. The LLM bridge trader wasn't just blindly yelling BUY or sell and walking away. It actively reassessed the trade and changed its mind based on shifting trend conditions.
Even though the daily total was negative due to earlier losses, this specific exit behavior was a massive success because it wasn't random.
Right. It saw weak trend conditions and it proactively managed the risk. That is the holy grail of algorithmic design, a system that can adapt in real time.
It's just so refreshing compared to the GateGrid bot that had to literally hit a catastrophic ceiling just to realize it was wrong.
Absolutely.
So bringing this all together for you listening, the ultimate lesson from June 18th is not raise the win rate. These bots already proved they can win 75% of the time and still lose money. The real question I want to ask you is, how often do you hold on to a project, an investment, or an argument just because you were highly confident when you started?
That is the core takeaway here. The true mark of an advanced system and a smart thinker isn't finding the right entry point. It's recognizing the exact moment your original idea has expired.
Yeah.
That is where the real improvement lives.
So what does this all mean? Think about it. If a machine, which has no ego or emotions, struggles this deeply to abandon a high-confidence entry and cut its losses, how much harder is it for the human mind to let go of a losing idea?
It's profound. We are biologically wired to want to be right.
Next time you find yourself defending a strategy that isn't working, ask yourself, are you looking out the window or are you just staring at an old weather report?